Good afternoon, everybody. This is Stan and Jack, and we're here to do a webinar on correlations, which we're going to start here in a few moments. Just our terms of use for any webinar or anything that we do here on The Art of Chart. We do these webinars for educational purposes only. None of what you're about to see is intended to be a trading recommendation of any kind. We hope that the way that we approach technical analysis, that hopefully you can take something away from this that's useful for you. And I guess with that said, what I'd like to do is introduce what we're going to do today. And what I'm going to do today is I'm going to introduce correlations. And there are different forms of correlations that, that Jack and I will talk about. And by the way, as we go through this, if you have questions, there's a questions tab. So feel free to key in your questions. And hopefully Jack and I will present, roughly 30 minutes of material. And as a result, if you have questions, please key them in, and then what we'll do is we'll answer the questions at the end. Okay, so I'm going to do 4 different charts showing correlations using futures. Now, commodities and currencies, if you are a commodity trader, okay, commodities and currencies do correlate, and knowing which currencies correlate with which commodities, I think it's very valuable. So I'm going to talk principally about oil and gold in the commodity world, but it also applies to other commodities like sugar as well. Okay, and I'm going to talk a little bit about ES and the S&Ps and how junk bonds actually correlates with ES. And I think a lot of people look at bonds in general, like they look at ZB, the 30-year, and they correlate ZB. When we get to the bonds conversation, I'll overlay the 30-year, and you'll see that it's a very weak correlation actually to the S&Ps. And I'll also talk about the dollar and how the dollar correlates with certain commodities as well. Okay. Now, the first thing about correlations that I want to talk about is the market as a whole. The market as a whole, it's a dynamic. Okay, and if you can pick up how there's an ebb and flow between like the dollar and gold, and an ebb and flow between, say, for example, oil and the Canadian dollar and the Aussie dollar, and how that works, okay? And even sometimes between the dollar and the indexes, okay? It helps your trading. It helps you understand where you are in a cycle. I think that's the key to it, really, to be honest. So with that said, Jack, any other remarks you want to make on correlations in general before we, I'm just going to hop into a chart and start walking through oil to start with.
Well, the other thing I'd like to mention is that correlations shift over time. So, I mean, I'm going to be showing a couple of the long-term charts to show how correlations sometimes reverse for long periods. The well-known correlations that people think are reliable are liable to reverse strongly for extended periods.
They do.
And obviously we need to be aware of that too. But apart from that, let's go.
Okay, sounds good. So what I'm going to do is a couple of things. First of all, I want to start up this in the background and get this loaded so we can talk about this as we go through this. All right, so let's take a look at oil. Now, first of all, on your chart, you're going to see 3 lines, and not to confuse you, but the actual oil chart is in the rainbow color. This one here that I'm showing you with the pencil, okay? This is oil here, okay? The one that's rainbow colored, okay? What I want to do is I want to show you different correlations with oil, and the first correlation I'm going to do is the light blue line, and the light blue line is actually copper. Okay, copper and oil are highly correlated, and a lot of people don't even think about copper and oil being correlated, but they are highly correlated. So I'm just going to take you through the blue line and the rainbow line first, and then I'm going to come back to this line here, which this is the Canadian dollar, okay, the purple line, okay? And by the way, it's often good if you're going to do correlations to, like, over a weekend. If you're looking at a chart showing, say, a 1-year sort of history, what you're looking at here is a 5-year history, okay? So, you know, over the weekend, typically I'm taking a daily view, and I'm looking at a daily view of where are we going in the next 2 to 3 months, okay? And if you're doing that, it's useful to add correlations to your technical analysis. Now, what I'd like to do is I'm just going to walk you through this correlation. Let's do the blue one first, the blue line first. Okay, so this is copper. Now, I want you to notice something about copper and correlations. First of all, they don't correlate exactly ever, okay, but the peaks and the valleys correlate, okay? So let's start from this low right here where I have the crosshairs. Look above where we are with oil. There was a low here in oil and there was a low in copper at the same time, okay? Where are we right here where the crosshairs are now? We are at a high. Well, check it out. It's a high. Here we are at a low, okay? Where are we? Right there at a low. Okay, and then we go higher and look where we are here. We peak in oil, we peak in copper, and we drop and look where we are. We're correlated perfectly with oil. Okay, now the swings here tend to be the swings are not correlated at all. Okay, so like for example, when I get to the Canadian dollar, the swings in the Canadian dollar are nowhere near as big as oil. Okay, so that's what I call a second degree correlation. Okay, where I would say copper is more of a first degree correlation. You can see the swings are fairly large, okay, like the oil swings are. Look at this large swing here. Look at that correlation right there, perfectly on the same day, okay? Here's the next peak. Now notice this is a peak, but it still climbs, right? So we get an inverse correlation here for a while, okay? So that's something probably specific to the copper market, but then it gets back on track, okay? Do you see this? We're back there again. Now, the thing I want you to note about copper in general in relationship to oil is it tends to peak before oil peaks. Okay, so right here, this high, it happens before the oil high. Now, the bottoms tend to correlate. Okay, that correlates almost exactly. This correlates exactly, okay? This bottom right here in oil correlates exactly. Okay, so bottoms tend to correlate with copper fairly dramatically, okay? However, the tops tend to be early, and now that gives you a bit of insight as a trader. It's you know, if you see copper peaking, well, you know that oil is about to peak, but it may not be fully there yet. Okay, we have a consolidation here in copper. Okay, look what happened. We dropped exactly to the same place. We peaked exactly to the same timing. Okay, so this is a fairly good correlation. There's a bottom. There's a top, there's a bottom, there's a top. I'm just going to go through this quickly. So there's a bottom, here's another top. Now notice this top here is nowhere near the same shape. They don't have to be. This is more or less what I would call a second degree correlation, okay? Here's a top, right? Here's a bottom. Notice it's different. This is just a bottom on the way to a top where this is a bottom. That's actually a signal that this, because we broke this low, in copper, that we're going to go much lower, okay? So we peak here, and then look what happens. Oil drops, copper drops to almost at the same time. They peak at the same time. They've dropped here at the same time, and they're in this consolidation right now at the same time. However, look where copper is. Copper is looking at a triple bottom, and by the way, there is no such thing in technical analysis as far as I know, a triple bottom. So likely copper is going to break and move to a new low, and likely oil eventually will do the same thing. So that's a very, very nice correlation, and so looking at copper and oil together actually makes a lot of sense. It works. Now I'm going to remove this correlation just for a moment, because I want to walk you through the HG. Yeah, I want to remove that. Okay. Now, this is a correlation of a different type. This is what I call a correlation in the second degree. Okay. Notice here we have a high, right? Now, notice what happens in the meantime. We move to a low. Well, there's the low, and here's the high, right? There's the low. It correlates very well, okay? But the swings in the Canadian dollar are nowhere like the swings in oil, right? Look at the low here. Here's a high, right? Now we have we diverge here, and do you remember the copper chart? It diverged at the same exact time. Here's a high, here's another low, and I could go through the whole chart that way, but you'll see that this correlates, but it's sort of in what I would say in the second degree it correlates, okay? And so the Australian dollar, and some people use, by the way, the Australian dollar Japanese yen pair, because the Canadian market, by the way, is one of the biggest it's a very large exporter of oil. The Canadian dollar is very reliant on the price of oil, okay? So that's one of the reasons why the Canadian dollar tracks so well with oil. However, the Japanese currency actually is a large importer of oil. So if you look at the pair, okay, of the Canadian dollar, Japanese yen, that actually is a very solid pair to look at that actually gives you correlations as well. Now, why are correlations important? Okay, if you're looking at a trend, okay, of some sort, okay, and for example, if you can predict with any certainty using structure work, some of the stuff that Jack and I do, looking at divergences, looking at patterns like this double bottom right here, right? So we have a double bottom here, and here we have this lower low that happened, but we see a double bottom in this particular technical analysis, and we also have a divergence, let's just say, here on the Canadian dollar. Well, that gives you that much more confidence in trading oil, okay? Because this would have been a great entry if we had done the technical analysis on the Canadian dollar before we made an oil trade. So if you see divergence on this double bottom, for example, okay, and here we are in this spike down in oil, okay, if I see a divergence in the Canadian dollar and I see this spike down, that gives me all the more confidence to get long in the face of this dump, okay? That's how correlations can be useful. So in other words, just doing what I'm doing on this chart, it actually isn't very useful. I'm just trying to show you and demonstrate where, you know, that this is a fairly reliable correlation. And again, as Jack mentioned, you know, correlations are not 100% reliable, okay? There are times, like I showed you here, where it diverges, right? But if you do the technical analysis on the Canadian dollar and you can show, hey, here's a divergence, this looks like it's about to bottom, we have a double bottom formation, or we have a falling wedge and we're about to get a bullish breakout, and you see that on a currency, well, it helps you to trade commodities, okay? So I think that's the main point I wanted to make on oil, Jack. So let me stop on this one. And if you're ready, I'm happy to throw it back to you to see your example on correlation.
Sure.
Okay, let me pass it back to you.
Yep.
I have a couple of other ones here whenever you're ready.
Okay. Right, now hang on. Do you see my screen all right?
Yes, very good.
All right, great. This is the long-term chart of the Nikkei. Let's expand this out slightly. Yeah, okay. So let's just increase that to 1280. And what I want to show here is shifting correlations over time. Now, this is the Nikkei plotted against the green background, which is the yen. I'm actually doing this. This is JPY USD, which I tend to chart, although I'm aware most people actually do it USD JPY. It's just that every other currency pair pretty much is traded. You know, it's GBP USD, Euro USD, etc. So I do Japanese yen the same way. It's and this correlation, I don't know, probably clearer if I inverted it, but this is a very, very strong correlation. And this is, when I called, you might recall me mentioning that I was calling a big decline in the yen here in late 2012, and we got that very big decline in the yen. What I wasn't expecting so much at the time was that the Nikkei would fly up at the same time. And this was a very, very strong correlation indeed. And actually, you can see it. We've got it while Nikkei is topping out and making, you know, a head and shoulder pattern, the yen. It's which you can quite clearly see on the charts. You've got Nikkei sort of trending down, forming a triangle, and then the yen breaks and goes down, and the Nikkei flies to the moon because of Japanese QE. Now, this correlation was very, very strong, inverted all the way along this chart. And this is from 2005. This is a long-standing correlation, and it's a very strong one. Look longer term, though, and it often flips. It's here you've got this is the again the yen in the background, JPY USD, and Nikkei in the foreground, and you can see here the correlation is switching around a bit. This is from the high in 1990, and here looking for areas where the yen and the Nikkei were both going up. You've got a period here, 1999 to 2000, 2001. And you've got both of them rising strongly. This is where, if you always depend on a correlation, sometimes over a long period it is going to invert, and it can invert for years. You see exactly the same on bonds and equities, where actually I'm not 100% convinced there is a real true correlation, actually. But I think you just generally tend to have a rising stock market in a period of lowering interest rates. And vice versa. But, you know, I think it's a correlation to an extent, but it's not really a very easily tradable one necessarily. So you've got here, you've got the, again, the inverted correlation. They're correlated directly here, they're correlated directly here, they're correlated directly here. The correlation only inverts actually here. So you've got from a very strong direct correlation from 1998 to 2005, but anyone who's still trading that would have been caught rather by surprise when it inverts suddenly in 2005, and actually the correlation has been an inverse correlation ever since. So that's now been 10 years. This sort of thing happens, and you've got to be aware of it, because otherwise, you've got to, it's not so much that you need to understand the reasons for a correlation happening, it's just that you need to be aware that you may not know all the reasons for a correlation happening. And therefore, because the world is a complex place, a lot of the explanations that people give for things are actually just rationalizations based on a superficial reading of what's going on at the time. They aren't necessarily what's happening. People's forecasting of bond prices being an absolutely classic example.
Yeah. The thing about correlations too, indexes are very difficult to correlate because they're very complicated instruments, and there are so many different ebbs and flows in the marketplace, where traditionally correlations in terms of commodities and currencies, that's typically where it's more commonly found. I think indexes, at any moment in time, an index can be inversely correlated with something, as Jack has just shown you, and then it'll flip. And that happens a lot. It's very common.
Yes. Now, what does this tell you about the Nikkei here? Well, as long as this holds, if we look directly at the yen chart, hang on, all right, okay. Now, this is the close-up look. That's US dollar in the background. I'll just switch that to the Nikkei. Update that. All right, here. Right, what's happening here on the yen? Well, we've had this big rise on the Nikkei and this big decline on the yen, which actually reversed the whole of this move, this rising wedge from there. What's likely to happen here? Well, we've broken the falling wedge from the high. We appear to be forming an inverted head and shoulders on JPY USD. This will obviously on USD JPY. This will be a head and shoulder pattern. Could retest the low here, but chances are this is going to start moving up fairly soon. What's going to happen on Nikkei then? Well, if the correlation holds, the Nikkei is going to go down, and it's going to go down quite a lot, because what I'm looking for here is really a move up to somewhere in this area here, going up to the 38.2 Fib retrace of this move down from here. Now, if we see that on the Nikkei, then that has the Nikkei coming down. You've got the rising wedge here. This is the mirror image to the, in effect, it's slightly different, but broadly similar to the yen pattern. And we've had the first breakthrough. We're forming a topping pattern. It's very hard to tell at the moment what that topping pattern is going to be. It could be a head and shoulder pattern with the neckline here, or it could go all the way back and retest the high. Both of them would have the same sort of target, which would be in the 13,000 area at the 61.8% Fib retrace. So what we'd be expecting to happen on the Nikkei is for it to go down there while the yen was running. That is a fairly confident expectation, but it's one you need to take with a slight pinch of salt, because it may be that this is one of those occasions where the correlation just stops working. Can I show another chart?
If you want to, sure.
I have an excellent example of where a correlation did stop working, and that's on the Apple chart. Now, long-term correlation with equities on Apple is very good. Obviously, Apple has outperformed equities handily, but generally speaking, if one is going up, the other is going up. This is SPX in the background in green, and this is Apple. So here you've got a period of non-correlation, but this is while Apple was, I think 98 was when that famous quote from the head of Dell that Apple should really actually just wind itself up and return money to the shareholders, because it was they were just wasting everyone's time. And Apple is now 200 times more valuable than it was at that point. So obviously, and Dell obviously is not. So hey, that's the way things work. But this actually reverses. You get back into a positive correlation, positive there. Basically, you've got a very strong positive correlation right up until here. Now, this is where I was looking at it, and I was seeing, hang on, right, I was calling it on the weekly chart. Now, let's get the weekly RSIs. Okay, now I was calling it short in 2012, and I was calling this high here. And I was calling it on the basis of this very, very strong divergence on the weekly. Now, you see these fairly regularly. In fact, we saw one recently. We saw it here. And and basically they always deliver big declines. Here you've got one, big decline. Gets down to the 30 level on the weekly RSI, which takes a big decline. It's on average, I was reckoning that I had 5 previous examples, and they delivered an average of a 45% decline in the stock, which is actually pretty much what we got in this instance too. So I was saying to Mike of Princeton Trader, I was saying to him, this is going to decline. Apple is about to enter a period where it declines, and the average decline would be 45%. What's going to happen to the market while this happens? You've got this enormously strong correlation, which has then, at this stage, been in place for 15 years. And so it seems a reasonable expectation that when Apple declines, which it declines from, well, with the current share structure, 94 to 53, so that's a very big decline. If the correlation worked the same way, that meant that the end of 2012 and the beginning of 2013 was likely to be extremely difficult for the stock market. How well did this work out? Very badly, because Apple went down and the market went up. In fact, 2013, basically from the open at the beginning of January, one of the strongest bull runs in a year that we've ever seen. It was a very, very impressive bull run, and for half of that period, you can see that Apple is basically bottoming out April to July. And then starts the current move up, which has just ended. So how tradable was that correlation? It looks pretty good at the time. It seemed a reasonable expectation the market would fall. Obviously, it didn't happen. That is the danger with trading correlations. Sometimes things are actually just happening at the same time. Apple may be more likely to go up when the market's going up, just because everything's more likely to go up, and more likely to go down when the market, particularly over this period where you have 2 crashes in the SPX. Big declines there. To a certain extent, what you're looking at here is just a liquidation of all assets. When Apple is falling for that reason, even though its prospects are excellent. So this is correlation causation in this instance. I think they were just really happening at the same time. So when it was time to correct on Apple, then it was not time to correct on equities, and they just diverged. This time the correlation is back. This time when Apple declined, the market declined as well, which is interesting because look at this pattern. This is the pattern on the non-log chart of the rising megaphone on Apple from the 2009 low. This is a nice pattern. This is unfinished business.
Yeah, right, exactly. I think we're going to go see that.
I think what we're shaping up with here is actually a bull flag. This is a bull flag channel retracement by the look of it. In which case, we're pretty close to the high now. Let me just draw that in.
I'm looking at 125s, Jack, for a nice natural turning spot for Apple to continue the decline.
Let's have a quick look and see
put a new low in. So I think that's. And by the way, I just want to say something. Trying to correlate a single stock is very, very dicey. Okay, I would caution you against it, to be honest, because you know, when you're trading commodities are based on certain currencies. Like, for example, oil and the dollar, right? Well, oil is purchased in U.S. dollars, okay, all around the world. So you know, you have some basis for the correlation in the economy, versus this is, you know, hopefully it stays correlated to the index, but if it continues to grow Apple, it may not. It may separate at some point in time.
Well, my longer term patterns are a bit doubtful about Apple here, actually. We may be putting in a major high.
Yeah, I agree.
But if we go with the bull flag channel, but the bull flag channel may actually just indicate that this high here will be tested in the future and then fail. And this could then, therefore, under that scenario, be major double top support. But I mean, if on the bear flag channel scenario, I've got a match with your 25, pretty much. It's pretty close.
I think guys, I think that's a good one. Anyway, I think what we have to do is show, and what I want to show, Jack, is how you look at technical analysis along with correlations, because I think that's a key piece.
Okay. Shall I pass it back to you?
Yeah, sure. I'm ready.
Okay.
Just to show an example. So let's imagine for a moment that you're trading gold. Okay, so here's gold, and I have a couple of correlations on gold. Jack, can you see the chart?
Yep.
Okay. So the salmon colored, or sort of orange colored line, if you will, is the Australian dollar. And as you can see, the Australian dollar, and the blue line, by the way, is the Kiwi. These are two currencies, by the way, that have a lot to do with the price of gold in the marketplace. Okay, so the rise and fall of these currencies, as you can see right here, for example, this low, this high, this low. And again, they don't correlate 100%. No correlation ever does. Sometimes there are divergences. But you know, if you look at where the lows are and where the lows are in the currencies, they correlate, and the high peaks, okay, and the lows and the high peaks, et cetera, et cetera, et cetera. So the idea here is to, first of all, find a correlation that you like and that you understand, number one, but then be able to transfer it into a chart. Okay, so what I do is I track, for example, religiously gold and the Australian dollar. So let me just go to the Australian dollar for a moment, because I think that's, and I also track the Kiwi, right? Now I trade the Australian dollar, but I don't trade the Kiwi. So I tend to orient around what I trade, because I know more about the instrument that I trade because I'm in it every day, okay? Now, with the Australian dollar, what I'm looking for here is a back test. You can see what I'm looking at here, and if I draw a couple of trend lines here, you can see where we are. We're at support right here of this trend, and I would say that we're in a bit of a megaphone formation here, okay? And so, you know, that X may be a little low. We have this falling 200-day moving average. I have a level here roughly at 75.46. I'm looking for us to go and make 75.46, okay? And I look at my correlations and I look at where we are, and let's go back to the correlation chart. Okay, so here we are on the Aussie, right? And I'm looking for the Aussie to go higher. The Kiwi is the blue line again, and look where gold is. Everybody remember the dump that we had on gold? Well, look at where it is. It's correlating with this low, and typically the lows in the Australian dollar actually, in my opinion, they tend to follow the lows in gold. You see this low here? You have a low in the Australian dollar here. This low here in gold, you have a follow in the Australian dollar here, etc. So what I'm trying to say here is that this low in gold, this is going to turn first, and then the Australian dollar, it should follow. So, you know, back to my correlation chart here, this may have one more, it may have a marginal new low to put in, okay, but I'm looking for this to go higher. Now, if I'm looking for the Australian dollar to go higher, what does that say about gold? Well, we go back to the metal chart and we go back to gold, and I'll show you that in a moment. they should be going in the same direction. Now, by the way, this is over the month of November. Okay, I'm looking over the month of November until the end of this month, roughly speaking, for the Australian dollar to go higher. Okay, it doesn't mean it'll go higher in the next hour. I'm talking about over the next month. Okay, so the turn in the Aussie is just starting to happen now. Okay, now look at where we are with gold. Okay, we have a correction of the Y to W wave that we're doing, and look how far we've come. We've come basically back to the bottom of the V wave. This doesn't have much lower to go. Okay, this could be the bottom right here, and this could turn, and this could go higher, but it gives me a hint that gold is going to go higher. As a matter of fact, I might be wrong about this, given what I just saw on the Aussie, and because gold leads, that could happen. Okay, it opens my eyes to another possibility that instead of this going down in 5, we could be done right here or very close to it. Okay, so it opens my eyes to maybe this is what's going to happen. It gives me sort of an insight into, well, I have to be careful here because we could break this falling, well, the falling wedge first of all has to break. You can see the falling wedge here, right? It hasn't broken up yet. Okay, that has to go first. The possible channel has to go before we can get up here. And I think it's going to go not in a straight line, of course, but correlations help you trade if you do the technical analysis on the instruments that you're trying to correlate. I think that's the main message I want to say. Having a chart like this doesn't help you trade. Having a chart like this helps me show you the correlation, okay, but it doesn't help you trade. You have to have a chart like this that shows the correlation along with whatever you're correlating it against. Now, let's just take a look at a couple of other ones real quick. This is one that I particularly like. Now, you probably don't see a lot of similarity between these, but the bottom 2 lines here are junk bonds, and the top line is the S&P 500. And I just want to show you this, okay? Look at the high here. Look at any high or low. Look at this low here, okay? Look at the correlation. It's absolutely gorgeous, right? Now, these little moves are correlated as well, and they're harder to see on this chart. I'd have to blow this up for you, but even these little moves have some correlation to it. This move here, look at it. It's nice, okay? This bottom right here, it's correlated, okay? So what we could do is walk through this entire chart, and I could show you the details here where this actually correlates very, very well, and it's a long-term correlation too. Here's a low, okay? It doesn't really diverge. Now the moves, this is what I call a correlation in the second degree, junk bonds and the indexes, right? Now, because the swings on junk bonds aren't anywhere as near as big as this, and also the overall direction of the S&P, of course, is straight up here, and junk bonds don't vary as much. But the turns in the S&P, this major turn here, right here it is in bonds, okay? So this is fairly well correlated, and even at this top here, okay, there was a little signal here, okay? So here we have this low, okay? We have a top in bonds, a double top in bonds, and then it starts to melt away while we're going sideways in this triangle, and we continue to go lower in bonds. What does that tell you? What tells you that we're building up some steam to do this, okay? So, and again, this is useful if you take the time to do the technical analysis on both, okay? So that's what I wanted to say about those two, Jack. Do you have another one you'd like to share?
Yes.
Okay, let me throw it back to you.
All right.
And I have only one other one, Jack, which we don't have to cover, and I want to leave time for questions.
Well, we got time.
Okay.
This is the really famous one, which is the one which people talk about a lot, which is the correlation between bonds and equities. I'm not convinced this is actually.
And you're looking at TYX or the 30-year, et cetera, right?
This is TYX. This is the monster falling channel on TYX.
Yeah, I agree with you. I don't see much of a correlation there at all, to be honest.
I think it's just that they tend to move in. The correlation, I think, is mainly about the fact that when interest rates are declining, bonds tend to go down, and equities tend to go up. I don't think it's particularly strong. I don't think it's enormously tradable over long periods. I think better than the correlation is an awareness of where interest rates are likely to be going. So anyway, such as it is, though, I actually a few years ago I was looking at the relationship between those four over long periods, and here, for instance, this period here, 99 to the bubble top, basically, start of 2000, you've got a big rally in bonds. And actually, this is a pretty sizable rally. This is going from, I think this is 45 to 67. That's a big rally. That's and over that time, you're having a massive increase in equities. How are you doing trading the negative correlation at this point? You are going bust rapidly. At this point, it then reverses and it's positively correlated again all the way down here. Then the correlation breaks down as bonds trade sort of sideways during this second bubble here. By the way, this is a bubble and this is a bubble, but apparently this isn't a bubble. What's wrong with this picture? Anyway, it's, so anyway, bubble one, you've got a positive correlation. Then you go back to a negative correlation for the bust. You lose the correlation essentially from 2003 to 2007 because bonds just trade sideways while the strong bull market is happening. You then go to positive correlation again at the bust, and bonds tank out and equities tank out at the same time. And then you are positively correlated again into the start of 2010. You're seeing the problem with this picture. This actually, I think in terms of big moves, this isn't actually a tradable correlation at all. You've now got everyone's convinced that they're inversely correlated again because we've now got, having had a period from basically 12 to the start of 14 where they were again positively correlated, we've then had the negative correlation back from the start of 2014. How reliable is this correlation? Not at all.
Yeah,
not at all.
I agree.
This is, it's really barely a correlation at all. But they do move in sync for considerable periods. How tradable is it? A lot less tradable than the Apple one, and that is not reliable. So this one will bite you in the ass more often than not, in my view.
Yeah, I agree.
And yet, nonetheless, this is one of the most famous correlations that an awful lot of people use. That's something to think about.
If I show you the, I have ZB up on a chart here, and I'll just show this briefly, Jack, and then we'll take a couple of questions.
All right.
But just to throw this chart in front of everyone. So ZB and indexes, right? There are a lot of people that swear by the correlation. Well, there are moments where there is correlation. Look at this. It's actually correlated in parallel right here. Okay, it's positively correlated. Well, here it flips to a negative correlation, right? Now, I would say that the junk bonds correlation is far more accurate and far more in parallel, easier to read, etc. Okay, so here the S&Ps drop, right? Bonds are now inversely correlated, okay, and then bonds drop, and of course the S&Ps climb. So, you know, it switches from inverse to positive correlation to a negative correlation back to a positive. So, you know, I have to 100% agree. I mean, when you look at this on a 5-year chart and you really look at how it correlates, it's nothing as reliable as what I said earlier about like gold in the Canadian, I'm sorry, the oil in the Canadian dollar. Yeah,
I think it's the least reliable of any of the correlations we've looked at.
I agree with you 150%. It really is. So just watch out for that one. The only other thing I had, Jack, was the dollar, the US dollar, but we're kind of running short on time. So what do you think? Do you want to move to questions?
Yeah, let's do questions.
Okay, let's do questions. Folks, we wanted to introduce the concept of correlation to you and try to introduce certain currency pairs with certain instruments, okay? Do you have questions? And I'll also show you how to use it in terms of doing technical analysis. So we're open to any questions that you might have. And we don't have any questions yet, Jack. So I'm going to give folks just a moment to do a question or two. And while you can see my screen, right?
Yep.
I'm just going to show a correlation between, and I'll do this briefly so people can ask questions if they have questions. We have here the US dollar, okay? Now the US dollar, people claim that it correlates well against oil, and I have to agree with them, okay? When oil makes a big move like this, you can see what is happening with the US dollar. The US dollar is going up. So there is an inverse correlation, a natural one between oil and the US dollar. And so you can track through this and you'll see the correlation. Some of it is in the second degree again. However, I want you to look at gold and the US dollar and how weakly correlated it is. There's not much correlation correlation at all between the gold and the US dollar. Does that correlation work at times? Yes. Like, for example, look at this. We're going up in the US dollar and we're dropping like mad with gold. Now, that's also partially due to some of the other currency pairs that we currently have. Okay, we just bottomed in the in the Aussie, and we just bottomed in the Kiwi not too long ago. So the Kiwi and the Aussie, I think, is the point I'm trying to make. They tend to correlate much better with gold than the US dollar. And oil also correlates very well with the US dollar, especially for the larger moves. I just wanted to point that one out. So with that said, let me just go to questions. We have a couple of questions. Okay. Stan and Jack, curious to hear your thoughts about today's action in ES. Do you have a perspective on that, Jack?
I do. Do you want to throw me the chart back?
Yeah, absolutely. Happy to answer that question. And the other one was about natural gas in terms of the current perspective on natural. So I'll tee up a chart on natural, Jack.
Right. What happened in ES today? Because what appeared to be happening initially is we've got a head and shoulder pattern here. And it broke down, and it broke down. It's looking good, and it needed to come back for a retest, and it blew right through it. What's happening here? Well, I think it's increasingly obvious that what we're doing is we're forming a falling megaphone. Ideally, we would see a touch of this trend line tomorrow morning, and then it would either break up towards a retest of the high, because this megaphone is a bull flag. And it is a kind of bull flag with a target which is back at a retest of the high. But I've been mentioning this since we broke the SPX rising wedge support. The fact is, I've gone back and I've counted something like 2/3 of all topping reversal patterns on SPX are double tops. And that means there's not actually just you might possibly retest the high, you will usually retest the high. It might not be an exact retest, it might go a little higher, it might be a bit lower, but you are going to get something which you are far more likely to get a double top than you are to get a head and shoulder pattern. This looks like a head and shoulder pattern, but I think in truth this is a falling megaphone, which is, I'm leaning towards it doing, and I'd be interested for Stan's view on this. I'm leaning towards it touching here and then doing another leg down, and then heading up and retesting the high. This could also alternatively be a topping pattern. If you look at the, depending on when the move is, if we were to hit that and decline sharply tomorrow morning, we can actually hit and reverse this trend line at this potential head and shoulder neckline here. Now this is one of the ones I mentioned, pointed out and mentioned in my my post this morning. I've got one here, I've got another one here, and another one here. These are all potential patterns potential areas where we already have a possible left shoulder, and we could put in a right shoulder. Now it could be that we would come down here, and if we hit this would be, if we hit this area and reversed up strongly there, it would actually be more likely that this falling megaphone would then break down. You would break against what you would usually expect. These are 70% bullish patterns, but obviously that means they break down 30% of the time. When they break down, they tend to make target rather more reliably in my experience. And it would then be supporting, you would then get a bounce there, a fail at this declining resistance. That would form a right shoulder on this pattern, and it would break down, and that would support the head and shoulders. Very strong topping setup, and I've seen that quite a few times before. But if we don't get a bounce in this area here, then I'll be looking for that to break up, retest the high, and then we would have, this would be, wherever this bottomed out would be the support level for a double top, and I'd expect a breakdown below it. So that's what I think happened today. It was kind of annoying, because I was called away in the afternoon. My stops were taken out by like 2 handles. Very annoying, but you know, that's the market for you. That's whatever you're expecting confidently to happen may happen, but often with variations, which can make life interesting. Right, great. What's your view on this, Stan?
I think there's a possibility we could break that trend line. We were calling for the low. Well, last night you and I were calling for this to break down, and we did that. And I think right now we have a good chance to break up. If you have a longer term chart, you can see how there is, we have the potential to have support here.
Is this lower wave triangle?
I would say that it could be. Let me just see for a second.
I'll say the RSI.
The RSI is the giveaway, right?
Yeah, I mean, the RSI is suggesting triangle.
And the triangle is suggesting that we have a breakdown out of that triangle. And to be honest with you, I haven't done my normal work on ES yet, but certainly that RSI is very triangle-ish. That's a compression move. I have to check my compression indicators, but that is an indication that we have enough tension in the market right here, enough compression for us to actually make a bigger move from right where we are. And by the way, today was supposed to be a trend day, and also tomorrow is supposed to be a trend day, and today wasn't a trend day, which makes tomorrow a stronger possibility for a trend day. So we'll see how that works out.
What we could do tomorrow, and this is something to bear in mind. Occasionally, you will get one of these which actually becomes a topping pattern. And the way it becomes a topping pattern is instead of doing the natural breakup, it breaks down. And we could see that tomorrow. If we saw an AM high which went and tested this trend line here, which is approximately S97 area.
Oh, that's a sell.
And then that's a great. And we trended down. Well, that could get pretty damn ugly. And if this was to become a pattern and we broke down from it, let's say in the 2080 area, then this is a topping pattern with a target at 2045. We've got pretty good support at 2045. That is a natural area to head to. I'm expecting lower. I'm expecting the absolute minimum we should make the 38.2. So 2023, but 2045 is a natural staging post on the way. And it's a natural area to have a target. This could be saying that, i.e. we could actually make an AM high here, fail, and just not come back. Trend down all day, break down through various support levels and so on. That is a real possibility. I'll be looking for a high there. A slight break of this trend line would not mean that this was breaking up. It could be a bearish overthrow. If we then broke up, made it to, let's say 99 or 100 and failed hard there, then that would, and got back and made a low below today's low, then that would suggest not only that this might break down, but that actually most likely it will. So anyway, be watching that with interest tomorrow morning, but I think that's what happened. That's what happened here. We formed a triangle. The overall pattern is a falling megaphone. This just looks like a head and shoulder pattern. It isn't one.
Okay.
Right.
It's pretty interesting. Natural gas, I have a chart. I just want to show that briefly, and then we'll take any other questions. Natural gas, we have been working out of a triangle thrust. I think we've covered that before on chart chat. But basically, we called the bottom right here and the turn right around $2.20 in the December contract. And of course, today we had a thrust. And am I surprised? No, not at all, because look at where we are with the RSI trend line. We have been trending in RSI. Even though this has been choppy and sideways, there has been accumulation in relative strength and momentum while we have been chopping around here, okay? And there's been little pops and things like that. But today was a squeeze for sure. And so as long as we remain above this trend line, we are going to go higher. Now, I have a natural stopping point for this right around the monthly pivot, $2.42. I think we're going to have a back test and we're going to go even higher. I'm looking at $2.60, $2.70, roughly speaking. I think we will then go even higher because out of a triangle thrust, that's what we have here, A, B, C, D, E. And when we hit this box, we call the 600 tick move straight down. And we've gotten that. We've gotten more than that. So triangle thrusts typically are going to retrace minimally to $2, roughly $2.90. Okay, that's what I would expect out of this thrust. That is, if the thrust is finished. We don't know if the thrust is finished until this trend line here breaks. Okay, it is very possible that that trend line I just extended right there, that we come up and kiss it and we drop to the next low. I mean, that is certainly possible. So
what we have got to guide us there is rising support. We now have a rising support trend line from the low.
That's right.
So if that breaks, then the natural gas bulls are potentially in trouble. But until that breaks, that's a solid uptrend.
I agree. I absolutely agree. Let's see if there are any more questions. I think we only had 2 questions. Okay, and we have a thanks, guys, from Alan. Thank you, Alan. And folks, I think that's a wrap. We're going to do these every Thursday. We're going to have another one next Thursday. Let me just preview it very briefly while we're here. The next one is going to be one that's been a big request. We've been talking about trade execution. People have asked us, how and when do you enter a trade, and how and when do you exit a trade? So this is not going to be so much about technical analysis, but about trading, okay? And folks have been requesting this, so we're going to do a webinar on setups and entries, and setups and exits, and how we do them. So I think that's something that we hope benefits folks who want to attend it. So that's next Thursday, same time, same place. So Jack, thanks a lot. I think we're done, unless you have something else you want to cover.
Yeah, we are. Pleasure as always, mate.
Yeah, same here. All right, take care, Jack.
All right, take care.
Bye-bye.